So the first part of today's investment series is going to be presented by the portfolio managers, myself, Yichen, Chris, and Nancy. Like I said, I am currently chair of the Red Hawk Fund. I am a student in the Albert's Masters of Finance program. And I have been with the Red Hawk Fund since December 2019 now, so it's been a little over a year. Yichen?
Hi, my name is Yichen. I'm also one of the portfolio manager at RHF Fund. I'm also majoring in MSF and I'm graduating this quarter. I've been at RHF Fund for uh, a year.
Hello, my name is Chris. I'm also a Master's of Finance student. I started my program in 2020 and I joined the fund on April 2020. I am a CFA level 2 candidate. It's good to meet you. Nancy, are you there?
Hello, everyone. My name is Nancy, and I am a senior undergrad student, major in finance. I am the new portfolio manager at the Red Hawk Fund. I have joined the Red Hawk Fund since June 2020, and thank you for joining our investment series.
All right, so as part of our journey to 1 million, we're gonna give you a little bit of an introduction and history on the Red Hawk Fund. We're gonna give you a quick walkthrough of our investment process. What do we think about when we buy an equity? We're gonna give you a few select highlights, our history, and then 2020, and that was the year we hit $1 million, and then what we're thinking of as we plan our strategies for the coming year. Nancy is going to get us started.
Yes, so I would like to share with you the Red Hawk Fund intro and overview. So the Red Hawk Fund started in October 29 with $250,000. We are a student managed investment fund and part of Seattle University Endowment Fund. We only invest in US large cap equity and we don't invest in utilities and energy sector. Our benchmark is the S&P 500 Fossil Fuel Free Index, and we currently have 25 student members, and including 4 portfolio manager and 21 research analysts. Our faculty advisor is Dr. Kathy Cao. Our student advisory board is comprised of Red Hawk Fund alumni. Finance Department Advisory Board is comprised of the industry expertise and our school finance department. So next, I would like to share our journey to $1 million with you. So in October 29, the Red Hawk Fund was founded with $250,000. We first bought our equity in November 29, and it was Nike. And fun fact, we still hold Nike today. The major change toward the end of 2018 is that the Seattle University announced that they would divest away the S&P fuel-free asset, and so our IPS was revised, and we switched to the S&P 500 fossil fuel free index, and we toward the end of 2018, there's a big market crash due to the U.S. and China trade tensions, and at the beginning of 2020, we suffer a major hit due to the COVID-19 outbreak, and then in December 2020, we surpassed $1 million due to the. So we try to use our cash balance to invest in undervalued stock, and that's why we surpassed $1 million. And this is our Red Hawk Fund performance since 2009. Our total return is 346%, and our annualized compound return is 13.5%. We did pretty good with some dips, as you can see at the end of 2018 due to the US and China trade war, and at the beginning of 2020 due to the COVID-19. And next, Ravija. Oh, sorry. So this is the Red Hat Fund portfolio composition as of December 2020, and our largest sector that we currently holding is IT sector. Our current balance is 1,000,000 $20,894, and our 2020 return was 23.67%, and we beat the S&P 500 fossil fuel free with 19.76%.
All right, thanks, Nancy. Next up, I'm gonna talk a little bit about our investment approach. And I'm seeing that a few of our graduated alums from Red Hawk Fund are joining us. So I'm so pleased to see you all here. Hi, Carol and Anvo and others. All right, great. So we're gonna talk about what we think of and just our overall process. And so our focus, according to our IPS, in adherence to our IPS, is on top-down analysis. Our focus is on fundamental, qualitative, and quantitative factors and long-term sustainable growth. So we do not engage in, let's say, day trading or selling short or other stuff like that. Like Nancy said, we invest in U.S. equities only, large cap. And at the security valuation level, we again use fundamental methods. We use intrinsic valuation as well as relative valuation. So we use the discounted cash flow method as well as multiples to gauge the price, the intrinsic value of a stock. So our process can be roughly broken down into three parts. The first is the asset allocation, which we do at the beginning of the year. And then next is the security selection, which our analysts do throughout the year. They present recommendations, and you'll see an example of that later today. And then we do performance evaluation or performance attribution to see what we did right, what we did wrong, and to adjust our process. So we take the top-down approach when it comes to asset allocation and security selection. We look at global economic factors as well as local economy factors and sector factors and analysis as well. So every summer quarter, before we set our allocation for the academic year, we do macroeconomic and sector analysis. All our members participate in that, and we produce reports about what we think is going to happen over the next year. And our asset allocation is based on these reports, as well as when we are making recommendations for individual stocks, we think back to these macroeconomic reports, and those drive our decisions as well. At the security level, we do industry analysis, we do competitive analysis, we study their fundamentals, their numbers, their statements, and then we create valuation models, including, like we said, intrinsic and relative, to make our final recommendations. In terms of asset allocation, our goal is to maximize our return by lowering our risk. And the problem is that if we follow only qualitative factors, then there's the possibility of bias to be introduced into our assumptions. And so the question is, how do we diversify our portfolio effectively while avoiding bias? And to address that, we use both quantitative models and fundamental qualitative analysis. So we use lots of historical data as well as forward-looking estimates, combine those to create our asset allocation. And recently, we've also started using machine learning tools and models in our analysis to kind of do a data-driven approach. We also use qualitative models and theoretical models such as the business cycle sector rotation theory and strategy. So depending on where we think the economy is in its business cycle, we will overweight certain sectors and underweight others. At the end of the year, once we've met our or tried to meet our target allocation, we will do performance attribution using this model currently. And so what this does is tells us how much of our performance was contributed by asset allocation, which portfolio managers do, and how much was security selection, which our research analysts do. And that allows us to gauge what part of our process needs adjustment and needs to be improved, and what part is working and we should continue with it. In addition to our valuation, We also do lots of team activities to support our members. Our members do workshops on investment related topics, such that we focus on the long term approach, but there's also other parts of investments such as derivatives and options trading and cryptocurrency. So our members do workshops on those. If they have special interests, we do new member orientations for everyone who comes through to our team. And then recently, for the last few months, we've started a YouTube channel where the managers post valuation basic videos to help our new members. We also do weekly open house hours, where everyone has the ability to engage with each other outside of our general weekly meetings, where we're usually running short on time and tight on schedule. And portfolio managers and RAs work closely together in small teams to discuss valuations and get feedback. And we are building a repository of resources in our Teams forum. There's already a lot of stuff there, and we continue to add to that stuff for the education of our members. In terms of community outreach, we do speaker events with experts in the industry. Some of our finance advisory board members have also come and talked to us, given us feedback. We try to do company visits with local companies, and we've done Nordstrom, Zillow, and Starbucks in the past. For the last several quarters, we haven't been able to do this ever since we went remote, but we are hoping to continue this as soon as we can, hopefully fall next year. And then, of course, we do investment series like we are doing today, to open up our team to through the rest of the community. And of course, we have lots of great advice. We have ongoing mentorship from Kathy, who attends every single meeting and looks at every single one of our valuations and give us feedback. We have insight from our student advisory board, which, like Nancy says, comprises of Red Hawk Fund alumni. And we have quarterly board presentations to our finance department advisory boards. They give us lots of great advice, and we are accountable to them for our performance as well. So using all these great techniques and using this approach, and with all this support, we've been able to get our fund to $1 million in December 2020. And Yichen next is going to talk about a few select highlights over the years.
Thank you, Ravija. So first, I'm going to talk about our longest holding and highest total return. As Nancy mentioned, we bought Nike on 2009. The total return is around 750%, which equal to 21% annualized return. But for the highest compounded annualized return, our best performing stock is Apple. We bought Apple on 2013. The compounded annualized return is around 30%. We typically do a long-term investment, but we also hold some stock under a year. As you can see from the left, we decided to buy Tesla on 2012 at $6. And somehow some analysts decided to sold it a year later at $8. The current price of Tesla is around $850. We also bought and sold Apollo in a year. So this is some highlights for our most recently purchased stocks. We purchased Raytheon, Lockheed Martin, and MGM on June 2020. So here is our some highlights from 2020. Our bottom holding stock is TSN. The weight is around 0.8%. Our top holding stock is Apple, and we hold it, the weight is around 10%. And our top performance stock in 2020 is actually MGM result. The return is around 82%. Next, I'm going to talk about 2020 in review. So we consistently outperformed S&P 500 fossil fuel free, which is our benchmark, throughout the year of 2020. From this chart, you can also see that we consistently outperformed S&P 500. From this chart, you can see as usual, we underperformed Nasdaq. However, except March and April, which is due to we hold quite large amount of cash at that time. So right now I'm going to talk about sector-wise 2020 return. Some disclaimer, because the S&P 500 fossil fuel free data is not available to us. So we are only going to use S&P 500's data to talk about sector-wise return. As you can see from the table, we outperformed every sectors except information technology and the material sectors in the S&P 500. Next, Nancy and I are going to talk about those details, and just some FYI, as mentioned, we did the we changed our IPS in 2018, and we did some IPS review in 2020. So we liquidated some stocks in this in 2020 due to violation of IPS.
Thank you, Yichen. So this is communication service sector performance. In 2020, the return for this sector is 37.09%, and we outperformed the S&P 500. For the consumer discretionary, we hold 4 stock and account for 12.14%. The return in 2020 was 44.69%, and we again outperformed the S&P 500. For consumer staples, we liquidate Darling Ingredients because it violates our IPS. In 2020, we outperformed the S&P 500 also.
Thanks, Nancy. So I'm going to talk about our performance for financial sectors. We also outperformed financial sectors, so we do not have a quite high return. In 2020, we liquidated Blackstone and KKR due to the violation of our IPS. We also liquidated PJT due to their volatile earnings. And for the healthcare sector, we also outperformed S&P 500, and we liquidated two of the stocks under these sectors due to IPS violation. For the industrial sectors, we also outperformed S&P 500, and we liquidate the CNI due to trading tension at that time. So for the information technology sectors, we underperformed S&P 500, which mostly due to the underperforming stock Intel of 2020, and we liquidate Lockmin due to its acquired by other companies. We also underperformed S&P 500 for the material sectors, and International Paper is one stock that keep underperforming, but due to diversification purpose, we need to find another stock to replace it. So next, Chris is going to talk about our comparison to the benchmark.
So as we have said multiple times, we have outperformed our benchmark in 2020, and that is also true for past 6 months. However, the past 3 months, we have been trailing the benchmark by a little. For the risk, however, we have been steadily outperforming our benchmark. And for Sharpe ratio, much like the return, we have beat them for a year and past 6 months. However, past 3 months, S&P Fossil Free has done a better job. Now I'd like to talk about our game plan for 2021. I'd like to begin with some COVID-related information, and then talk briefly about political changes, and then about market outlook, and then our goals for 2021. So first of all, the current statistics of COVID-19, we have seen a steadily increasing trend till mid-January. However, it is steadily decreasing at a rate of 30% over 14 days. 4 states are seeing a steady decreasing trend. However, the death rate is flat across 14 days. For the vaccination, about 10% of the US population and around 1.38% of the world population has now received the vaccine. Approximately 1.3 million people in the US are receiving a dose per day. And the Washington state is currently in phase 1B, tier 1 on the vaccination plan. However, future plans are not yet solid, and approval of AstraZeneca's vaccine may be a crucial step for that to happen. Next, in political changes, especially in the energy sector, Biden's plan on $2 trillion investment in renewable energy paired with re-entrance of the Paris Climate Agreement and our plan on net zero emission as a nation by 2050 is going to heavily affect energy sector as well as industrials and materials as well. For monetary and fiscal policy, plan for additional $1,400 per person as a stimulus check is currently in debate. and Biden's tax plan has shifted focus to individuals in the top percentages. As for the market outlook, it's going to heavily depend on the timing of the vaccination phase 2. The federal rate of 21 is shown in the graph. It is a bit compared to 2020, but unemployment rate forecast and the treasury rate forecast that the normalization might take several years. Also, in the government debt due to COVID-19 spending is also a very concerning trend. Next up, the market volatility. We have seen three sources of volatility. First one is of the investors' post-pandemic performance, because most investors are expecting the pandemic to be over by the year. They are expecting a surge in the market. Therefore, the news regarding COVID-19 may be a huge volatility point. If they receive a dissatisfactory news in the market might overreact to that. Also, the third one is very recent, but behavioral patterns of the investors might shift because of the GameStop um, incident that just happened over the past week. The implications of that, however, Red Hawk Fund is focused on the long-term holding and value investing as per our IPS. Since these volatilities will be mostly temporary, we do not think it would heavily affect our strategy. Next up, I'll talk about the goals and the target allocation. So none of these sectors deviate more than 3.3% from the target allocation. However, we are holding a lot more cash on hand than we want. So we are looking to reduce our cash holdings and diversify in certain sectors such as IT, financials, materials, and industrials.
Thank you, Chris. Lots of information there, so we'll open now for questions. Nobody has any questions?
You guys completely avoid penny stocks?
I'm sorry, could you say that again?
Do you guys completely avoid penny stocks?
Yeah, we only invest in large cap US stocks. So our IPS dictates that we only invest in stocks either in the S&P 500 or the Russell 1000.
This is Wilson speaking.
Hello.
Hello. Well, first of all, outstanding job. Congratulations for the great work and the great performance. Yeah, my question is along the same lines. Now that the portfolio reached $1 million, is there any idea in terms of diversification, trying to move away a little bit from US domestic stocks and diversifying other assets?
Great question. So the reason why we are focused on US equities only is because while of course one of our goals is to outperform our benchmark, our primary goal as a student-run fund is education, and just to give students a real world experience when it comes to working with real money and investments. So this is why when the Red Hawk Fund was set up, it was set up with this purpose in mind, and so the whole educational approach, it's conducive to usually like long-term investing philosophy, just because there's a lot of fundamental valuation involved, and also by the time we go from valuating something and recommending a particular asset to trading it, it can sometimes be weeks or even months, because of our rigorous process of feedback, and just like a group discussion, and then it goes to faculty members for approval. So trading options or trading assets that take advantage of short-term market timing is really not possible in such an environment, and also given the resources that are available to us, we might not have enough information to go off of if we are trying to do non-public companies or international companies. So right now we're going to be focused only on US equities, but in the future such a discussion might be beneficial to the fund. Yeah, there's just lots of barriers to expanding our investment.
Awesome.
Yeah.
Thank you.
opportunities. So, thank you for that question.
Hello, this is Father Bob Grimm. I don't know if you can hear me. Just a question. I serve with Wilson on our social investment subcommittee for the trustees. So we've considered a lot the question of values and how they relate to investing. How do you bring that to bear on your own activity in regards to whether it be environment or other social issues of concern or impact?
Great question, Father Grimm. So this was also something that we discussed with the Finance Advisory Board at our last meeting, of how we, bring all these values. So of course, once Seattle U divested away from fossil fuel assets, we also converted to the fossil fuel free benchmark, and we do take into consideration ESG. Mostly in a qualitative manner, just because there's no good quantitative way to incorporate that into our valuation. But ethical investing, so this occurs as a group when we discuss things. This is always a question that comes up whenever somebody presents a recommendation. We advise our analysts to also take that into consideration when in the first place they are choosing a company to value. And then usually we will discuss ESG implications in our valuation and recommendation as well. Bloomberg does publish ESG scores for companies, but most of these are self-reported by companies, and there are also no good comparison across industries. So while we do have that information available, there is no good way to really incorporate that into our analysis. So that usually takes place through discussion, qualitative discussion in our team.
Thank you.
Thank you, Father. Other questions, please?
This is Sam. So there have been quite a number of companies that the fund divested from, and the reason given was it violated the IPS.
Right.
Could you dive deeper a little bit into that?
Absolutely. Hi, Sam. Nice seeing you here. And let me go back. So, like I think Yichen mentioned, that we and Nancy also mentioned, we had a big IPS review change towards the end of 2018. And that involved divesting away from fossil fuel assets. And also, there were more restrictions on, okay, you can only invest in companies in the S&P 500 or Russell 1000 indices. So when we did a review of our portfolio in the beginning of 2020, some companies came up, such as Darling, which was not a part of those two indices, so that was divested. Some of them, for example, Takeda in healthcare, um, there it is, right? So that is an international exchange, listed on an international exchange. And the reason why that is in our portfolio is because we used to hold a subsidiary of Takeda, and then that got acquired. So, that stock got converted to Takeda stocks, and became ineligible for our portfolio. For Novo Nordisk was a similar story. It's on an international exchange. KKR and Blackstone again are not part of S&P 500 or part of the Russell 1000 index, which is why they were also liquidated. Yeah, if that answers your question. So there's mostly lots of changes in our IPS, and then 2020 was when the big review was done for our portfolio. And so those securities that were found to violate our rules with our changed rules were liquidated.
Thank you.
Thanks, Sam. Any other questions? Oops. Okay. But thank you all for asking. If there are no other questions, we're going to go over to the next part of our program today. An exciting part, which is our Kahoot trivia game. So we're going to give you a couple of minutes. You can go to the kahoot.it website, or you can go to the Kahoot app if you have it. And we'll give you a couple of minutes to get that set up while we pull up the game. All right, folks, this is the pin, and we will wait for everyone to join. Hopefully you've been paying attention because lots of questions are from the presentation that we just had.
Can I see the link again, like the code?
Yeah, it's just this, the www.kahoot.it. All right, we have 1, 2, 3. Do you all need more time? Are we good to go? Is anyone still joining? 22 people. Okay. All right, we're gonna go ahead and get started in about a few seconds. If you're still trying to get in, please send us a chat to let us know. Otherwise, we will get started. All right, I'm gonna go ahead and lock this. Get started. 15 questions today. And let's see how much attention we've been paying. Okay, so when was the Red Hawk Fund first started? Easy one to start us off. Was it December 2009, November 2009, October 2009, or October 2008? I see some smiles. Okay, looks like most people know this. It's good. Great. Okay, not bad. Okay, which of these equities is our longest held stock, which we have held for over 11 years now? Almost from the very beginning. Another easy one. All right, it is Nike, that's right. Nice, okay. And which of these stocks in our portfolio boasts the highest compound annualized return at about 30% a year? Got most people in, waiting on maybe a couple of people. Great, the answer is indeed Apple, which has driven quite a bit of our success. What was the total percentage return that the S&P 500 index made in calendar year 2020? Oops. Okay, 18.4 is correct. Looks like a few people got it right. Great. All right, next up. In which month did the Red Hawk Fund reach $1 million? Which month and year?
It's not even February 2021.
Well, I mean, we are in February 2021.
Oh, it is.
It is February, yeah.
I'm living in the past, I guess.
Yeah, great. Most people got it right. It was December 2020, and we've been celebrating ever since. Next up, approximately what percentage of our current portfolio is held in cash as of December 31st calculation? Is it 9%, 13%, 11%, or 2%? And the correct answer is 11%. Job. What is our cash target for this academic year according to our latest asset allocation that we had in our presentation? 2.5%, 6.5%, 8%, or 4.5%? Okay, almost everyone has their answers in, and yeah, some of you did remember correctly. It is 4.5%. Excellent. Next up, according to our IPS, which of these assets are we allowed to hold? Is it US large cap equities, call options, put options, or futures contracts? Which one of these are we allowed to hold in our portfolio? Yeah, most of these are pretty easy, for me at least, I guess. That's right, almost everyone got it correct. We are only allowed to hold US large cap equities per our IPS. What is the second largest sector by weight in our portfolio as of December 2020 calculation? Is it information technology? Is it consumer staples, healthcare, or the materials sector? All right, almost everyone. Great, looks like people were paying attention. That's wonderful. Healthcare is our second largest after IT, which is our largest sector right now. Which is a sector we do not invest in? Communication services, industrials, consumer discretionary, or energy? Again, this is something we do not invest in at the Red Hawk Fund. Looks like almost everyone got it right. We do not invest in energy. Completely divested away from it starting 2019. And which is not a part of our investment process? Is it asset allocation, security selection, day trading, performance attribution? Wow, that was quick. Okay, wonderful. A few more questions to go. Which company's stock has been in the news recently following its short squeeze triggered by investors on Reddit? This was a Reddit community called Wall Street Bets, and everyone's been paying attention to the news. Yeah, very interesting times in the market. All right, for our asset allocation, which sector in our fund is the furthest away from its target with a gap of 3.3%? Information technology, consumer staples, consumer discretionary, or the utilities sector? Good stuff. Some of us did get that right. Information technology is actually, I think, maybe the closest. It's capped off at 25%, and it's about 25.9% right now. All right. Next up, according to the latest Bureau of Labor Statistics jobs report, which just came out today, what is the unemployment rate in the United States? Jobs report comes out first Friday of each month for the past one. So the January jobs report came out today, and some of you are right. The current unemployment rate with January data is 6.3%. All right. And this has double points. What is the total return of the Red Hawk Fund from its inception to currently, which is measured as of January 13th, 2021. We presented that in our presentation as well. And we've got most everybody in, and most people got it right. Thank you everyone for participating. We will announce winners right after this equity presentation that two of our analysts are gonna present. So I'm gonna give them a couple of minutes to set up. This is going to be part of our consumer staples sector, and Hilal and Bridge, who are both part of our fund as research analysts, and both graduate students at Albers are going to present their evaluation and recommendation on this. Are you both ready?
Let me unmute myself, sorry. I am opening the presentation right now, and then I will
Great.
share my screen.
Wonderful. And whenever you're ready, please introduce yourselves and take it away. Bridge, you want to introduce yourself and get us started?
Oh yeah, of course. Hello, everyone. My name is Bridget Jackson. I'll be presenting alongside Hilal today. We'll be presenting Procter and Gamble stock valuation. Go ahead, Hilal. So for Procter and Gamble, we have a buy recommendation for the company. Right now, the stock is currently trading at $128.38. We see a 12.33% upside. Target price of $144.21. We will review, today we'll provide the company overview, which will include the industry analysis and competitive positioning. Also, Hilal will provide a detailed valuation, financial analysis, and investment risk, and then we'll close out our presentation. Procter & Gamble was a company that was founded back in 1837 by William Procter and James Gamble. The company actually specializes in a wide range of personal health care, personal care hygiene products. Many may not know, but they also have an arsenal that includes food, snacks, and beverages. The company is currently headquartered out of Cincinnati, Ohio. Stock ticker, PG, and it's publicly traded on the New York Stock Exchange, the Dow Jones, and also the S&P 100 and 500. So there's some news with Procter & Gamble. They have new product release out, something called the Microband 24. So this product was released back in February 2020. According to the chief brand officer, this product is on fire. It's supposedly going to revolutionize the way we do things. Also, the company has things in the pipeline as far as how their employees work remotely, how schedules are designed, and they're giving their employees the power to actually design their own schedules. So that's good stuff. Quarterly revenue rose about 8% for the fiscal 2020 that ended December 31st. There's some environmental things that Dawn has put into place. They have this new product called the Dawn Power Wash Dish Spray, which basically you use less water. So it's like washing dishes, no water. So that's a cool product on the way. See right here, as you guys can see, or gals, the revenue by segments and region. As far as the revenue by segments, fabric and home care lead the way at 33%. Baby, feminine, and family care follow 26%, beauty at 19%, and rounding out the percentages, we have healthcare, corporate, and grooming. As far as revenue by region, they hold a large weight over in the North American sector at 47%, Europe at 22%, Asia Pacific at 10%, and rounding off those percentages, Greater China, Latin America, and India and Middle Eastern Africa. All right, so these, are familiar products. I'm sure everyone has used the Charmin, the soft Charmin tissue in their home. We also have the Bounty paper towels, Tide pods, and other products that everyone's familiar with. So this is their product line. Competition is fierce for Procter & Gamble. As you see here, there's some major players in the game. We have Unilever, Johnson & Johnson, Colgate, Palmolive. You may see this Costco as a big box retailer showing up on here, but Costco is trying to get in the game too. So apparently they're presenting their own product that's going to compete with Procter & Gamble, their own product line. So right now, this slide, we move over into household spending. So the projected average consumer is expected to spend about 5.7% on household. The COVID pandemic has definitely had an effect on this business. There's just a huge increase of awareness due to COVID-19. There's more money as far as less disposable income, but the portion for this segment increased significantly. And here you'll see, this is the fabric and home care. All segments were expected to grow, of course, before the pandemic, between 2 to 3.5% from 2019 to 2025. So since the pandemic happened, of course, things changed. The whole game changed. There was increased awareness for hygiene. Everybody want keep your hands clean. Let's wash clothes. Let's wipe things down. So that had a major effect on everything, and it adjusted and added 4%. As you can see here, based on the Statista graph, laundry care and home and laundry care is around 4%. Online shares for the segment were expected to grow by 4% from 2019 to 2023. And view the graph there shows that. Next topic here, we have tissue and hygiene products. So baby diapers shows the highest growth potential among all the segments, and is expected to grow more than 22.5% between 2019 and 2025. And there may be some talk, people are home now more, so there is possibly a baby boom going into play. I mean, I know a couple of people are having kids out of the blue, so maybe we're looking at a baby booming thing in the future. And here, as far as tissue and hygiene, 2019 expected was 3.2% growth. And then pandemic hit, the overall estimated revenue for the total market for 2020 had to be adjusted by -2%. So beauty and personal care is also another sector presented by Procter & Gamble. Personal care is the largest sector in the beauty segment, coming in at 45%. The cosmetics section or segment shows the highest growth and is expected to grow by 32% between 2019 and 25. And also skincare will grow as well. So prior to COVID, it was expected to be 32% as far as the growth rate. But however, beauty and personal care took a big hit. Shutdowns due to COVID, which caused issues in manufacturing, warehouse. So according to Statista, the adjusted amount equals -7%. All right, and now we get to the Porter's 5 forces. As you see here, there are threats. The competition is fierce in that area, which Procter & Gamble in that space. Large number of firms, high variety of firms, low switching costs. There are some positives to mention. The entry is not easy. Supplier power is very low. Okay, and then we have some products here. So the industry is changing. There are trends here. I'm not sure if you guys are familiar with these. Over there is a product created by a company called Nova, which is basically a smart diaper that connects to the phone. So when the baby poops, it'll send out a message to your smart device and give you a heads up on, what's going on in the diaper. Another thing we have here is also the colorful toilet paper is back. For some reason, this is the trend. People want hot pink for when they use the restroom, or maybe some Ben Franklin's. So colorful toilet paper and patterned toilet paper is back on the scene. So I'll go ahead and pass it over now to Hilal.
Hi, everyone. So my name is Hilal, and I'm going to talk about our valuation and then financial analysis. And then lastly, I will talk about investment risk, and we will conclude our presentation. And bear with us, here is the fun part. So we did intrinsic valuation, we used the free cash flow to the firm, and then we did the relative valuation using price earning ratio and enterprise value and to EBITDA. And in our valuation, we got 70% of our DCF and then 30% of our relative valuation. And we ended up having $155.25 from the DCF model, and then for the relative $118.45. And then we ended up having $144.21. So in our intrinsic valuation, what we did is we used a split income statement by segment. We basically separated each segment into revenue, and then we projected our revenue by using moving average, and we also considered revenue portion in total assets. So going deeper to our intrinsic valuation, our target price is $155.25, and then the current price is actually $128.38, and then this gives us a 20.93% upside. So for our weighted average cost of capital calculation, actually, I want to talk about beta a little bit. So some of you already know what beta is, some of you don't. I will just briefly explain what it is. Beta is actually a systematic risk relative to the market. Another meaning is how the investment covariates with the market return and some other stuff, of course. It is basically a relative measure. It was actually quite challenging to come up with a right beta because consumer staples like sector beta was actually quite high compared to companies beta. The consumer staples beta was 7.75, and then the company beta was 0.38. So what we did, we got the value line data and other data, and then we just averaged them, and then we got a middle number somewhere here. And then the rest of it is usually from 10K, and risk-free rate is from treasury.gov, and then we have a 5.11% weighted average cost of capital. And then for the relative valuation, we got comparables forward PU ratio and enterprise value to EBITDA ratio, and we took their median. And for the PU multiple, we have a target price of $113.49, and then the enterprise value to EBITDA, we got $123.41, and then we weight them equally 50-50, and then we got a 118.45. Moving on. So for we did a little, like I said, the beta and WACC is really important in our valuation, in every valuation, because they make a lot of difference. So we did a sensitivity analysis to see the different scenarios. We have a terminal growth rate of 2%. We did a research on the terminal growth rate, and the lower range was 2%, and the high range for this company and sector was 3.5%. And we wanted to go with the low range because we wanted to be conservative in our valuation. And as I said in the beta, actually company beta is 0.38. And so as you can see, with the terminal growth rate of 2%, the price actually shows that the 270.39 cents. So it is really good to see the other scenarios using sensitivity analysis, and we can add more risk analysis in our valuation also. So moving on to financial analysis, I want to talk about dividend first, and then historical and forecasted performance. And lastly, I will talk about comparable of total returns in some about some companies in the industry. So Procter & Gamble is actually called one of the dividend aristocrats. Why I want to talk about dividends specifically, consumer staples is a non-cyclical sector, meaning that regardless of what happens in the economy, these companies is going to do well. At least they're going to stay steady because we need their product no matter what happens. So that means less risky, but you're not going to get like huge returns, or we wouldn't expect a huge returns from these investments. So when you're investing in consumer staples, it is important to have a good dividend yield. And Procter & Gamble have a $3,163 on annual dividend, and their dividend yield is 2.47%, and is actually their 131st consecutive year of paying dividends, and it has increased since like 64 consecutive years. I have also included some article into our valuation. If you want to like reach out and get the articles, I can also send them to you specifically, and I have it in the Teams also. Moving on to comparison of dividend payouts. I got this data from Bloomberg, and then I wanted to make a chart for you to see. So this is a 3-year dividend payouts and 1-day returns for Procter & Gamble and its competitors. And as you see, the first one is 107.50%. Procter & Gamble is leading with the dividend payouts, and then its competitors following with 95 and 70%. And you can see the others also. Okay, so gross margin, gross and operating margin forecast, and you can see the historical margin also. As you see, it's in 2014, you can see 48.08%, and then here's the 2020. It is quite high relative to past, but we don't expect to be, expect to have this margin in 2021. So we decreased our margin slowly and steady, and then the same thing with operating margin. So I just wanted to show you some companies in the industry and their return, and I also add S&P 500 total return to compare. So as you can see here, the purple one is S&P 500, and it is leading the return chart, and this is a 5-year return, by the way. So the Procter & Gamble is the second one, and then we have the PepsiCo, Colgate, and Coca-Cola. All of you know that we already hold Coca-Cola, Colgate, and they're actually doing great. And if we have the Procter & Gamble, that would also have a good payout. And then moving on to investment risk, as we said, consumer staples is a safe sector to invest, but there are of course some investment risk coming along. So this company specifically is in mature growth cycle, so it's not gonna be in growth cycle. So it is mature, and it is there's a high competition, and that's why they have a big budget on marketing. And inflation rates and interest rates are big factor to check on and keep eye on. And then the global economic environment is really important for them, because the fluctuation in their revenue is usually, you can find this information in 10K also. Fluctuation in their revenue line is usually mostly caused by the foreign exchange rates. And also another one is COVID-19. COVID-19 affects this company by creating supply chain problems mostly. So as all of you remember, we weren't able to find some cleaning products in the beginning because they weren't ready for it. So if another shutdown happens, they may get affected by it. But like I said, no matter what happens in the economy, we will need their product, and we won't, this company won't get hit significantly by supply chain problems. So I wanted to add this chart here. This is from their investor presentation. So as you see, their rank is always #1, but it doesn't mean they're going to be #1 always. Like I said, this is a competitive sector, and it is easy to switch to another product because it's a low cost of switching. And yeah, they have to keep up with their marketing. And then as a conclusion, this is a potential buy with a good dividend payout. And the current price is 128.38 cents. And then the our price is 144.21. And this is a buy suggestion from our valuation. And if you guys have any questions, we are open to.
I do have one question. Could you go back to the operating margin, that slide, please?
This one?
Yeah, so you said that you are not expect a high gross margin in 2021, 2022. What's the reason for that?
So in 2020, people are more like hygiene. They have hygiene awareness since the vaccine is coming out, and they will be more relaxed on cleaning and being like, it's gonna be less hygiene awareness, we are assuming. And also people are stockpiled a lot of cleaning products. For example, I don't know how many bleach in my house right now, but I'm not gonna keep stockpiling them. I will just keep them, use them, and finish them, right? So these products, even though they are, we need them all the time, we have to finish what we stockpiled. And like I said, the vaccine is coming. Maybe some of the habits is gonna stick to us, but it's not gonna be the same. Like, it's not gonna be scary like 2020 once the vaccine is present for everyone.
Okay, so what's the prime driver for your buy recommendation? Like, what's the prime driver for the revenue growth rate?
So I actually follow the historical trend. Also, like I said, the 2000, their number is actually historically really good. This company is a big and old company, and they're really, they know what they're doing. And for, if you're asking qualitatively, we follow the historical rates, and we also add our insights on hygiene awareness, and like their product is the best in the market, almost like, so I think they're gonna have the almost same margin, not the same, but close to their margin in 2020. So we have the 50.15%.
Okay, thank you. Great presentation, by the way.
All right, next question from Nancy and then Carol.
Go ahead, thank you.
I have one question in terms of relative valuation. So what's your reason for selecting those peer companies? For example, I saw you select Estee Lauder, and their forward P ratio and EV per EBITDA is quite high compared to PG, the company itself. So is there any reason behind
Yeah,
that?
so the Estee Lauder is a beauty company, and Procter & Gamble is actually operating in beauty segments too. And I didn't want to leave out beauty segments. And I realized we have an outlier in relative valuation, which is the Estee Lauder. That's why I gave 30% weight on the relative. Normally, I would maybe give 70, 90%, but I thought I should give only 30 because of the, I didn't find it is close to reality. So I used the 70% of intrinsic valuation. But like I said, I didn't want to leave out the beauty segments because these Estee Lauder is the biggest competitor in beauty. So I had to add them.
All right, thank you, Nancy. Next question from Carol.
So can you go back to the revenue projection slide?
Sure.
Yeah, I have a question, like why you choose the moving average method for revenue projection?
Here. So why I used, there is no specific reason. I was just looking at the options that I can do. And I tried linear regression models and polynomial regression models. I tried a couple of them. And so at that point, we use our insights, and we use whatever is more logical to us. And the numbers showed moving average was working better than the others. So, and also, like I said, not specifically only moving average. I use moving average, and I add some of the quantitative, qualitative analysis that we read on 10K and from our research.
Okay, thank you.
Did you also, following that revenue projection, did you also break it down by segment when you considered your revenue growth?
Yes, for the we wanted to, because this is a big company and they have many segments, and each of them has different growth rates or different like different regression, I would say. So for example, the corporate was really not good, and the fabric and home care was great. So we wanted to specifically look at each segment and their growth, and then we wanted to do our projection by only like looking at that segment specifically. So we did a split income statement.
All right, thank you. Anybody else have other questions? I don't see any raised hands. All right. Another question. So Bridget and Hilal, this company, they create a lot of they sell a lot of products that like toilet paper and such that are disposable and produce waste. So have you looked into are they doing anything to reduce their environmental impact?
Yes, actually, like that's why I wanted to add that product we talked about in the beginning. They're actually working on
the diaper thingy.
No, they're not working on the diaper. That's a different company. That's just a trend in the industry.
Oh, I see. Okay.
So this is this Dawn Power Wash dish spray is actually aiming to use less water, especially for the places that are facing with the drought, and also they have to keep the hygiene. So they are actually working on products that are good for the environment and for the people. And this is one of the product. They have more actually. I can give you specific examples later when you're free.
Yes. And Ravija, just to chime in real quickly here, data shows that 100% of their plants are using zero manufacturing waste to landfill. So Procter & Gamble, they're not just this company just generating revenue. We're selling toilet paper. They're actually doing things to protect our environment and to cut down waste as well. So that's just something I would like to add to that as well.
Thank you.
I got a question. So would you say that Procter & Gamble spends spends more time acquiring other brands or producing these brands in-house?
So go ahead, Bridget, go ahead, please.
I mean, and hopefully I'm giving you the right answer, Joe. It seems like they're producing a lot of this in-house. I mean, I've looked up acquisitions for Procter & Gamble, and they've been quiet for some years. I mean, if anybody on here remembers like Oil of Olay, and it's still around. I mean, that was an acquisition that they did, many, many ages ago. There was some talk about acquiring the shaving company Billy. Apparently that fell through due to, they can't monopolize the shaving industry. I mean, they have tons of grooming stuff already. So they seem like they're just creating things in-house and creating brands that people just want to use and continue to use.
And the main reason they're actually thinking to acquiring a grooming company is because the grooming habits changed. People are not shaving that much anymore. So people are switched to more like bare health, or like they are just looking for oils to keep it healthy, or so it's the shaving habits changed, and maybe it's gonna go back to normal. But right now it's the new trend to have this man's beauty or their beard beauty. So they are just actually keeping up with the industry, I would say.
Next question to Nancy again.
Yeah, I have one last question. So you mentioned that the home laundry care online sales is expected to increase. And so my question is the company, does the company have its own DTC channel? Does it have online platform?
Bridget, do you know anything about it?
No, not as far as I know.
I don't think they said
I could dig, I could dig in and maybe find that, but I think it's mostly just with the big box retailers.
Yeah, that's what I know also. I don't think they have their specific channel to do their online share. But I remember I read on their 10K, they're actually working on their like increasing their online share, and they may have something like that, but I'm not certain. I will definitely check that and get back to you.
Yeah, thank
I
you.
had a quick question. So
Sure.
P&G is a global company, and I'm assuming that a lot of their revenue come from foreign sources. Do you think foreign exchange rate affects P&G's revenue, and what do you think about the future of that in
So
regards to P&G?
in 10K, you can also find in our Excel sheet the reasons for the volatility during the years. You can also check that. You can find the detailed information. But I will say, yes, they are actually operating globally, and mostly the fluctuation in their revenue is caused by foreign exchange rates. Sometimes it's 6%, sometimes it's 1%, and some years was huge. I was actually surprised to see that was affecting their revenue that much. Yes, they're the biggest reason the fluctuation happens is the foreign exchange rates, but their biggest region is still North America. So you can see here. Sorry.
Do you know if they hedge like foreign currency costs to these fluctuations to address them?
Can you repeat the question? I'm not sure if I understand.
Do they hedge those costs of foreign currency fluctuation, exchange rate fluctuations? Do you know?
No, I don't.
Okay.
But
I want to have it in their 10K so we can look into that. Yeah.
Yeah, definitely. Yeah. So they're separating their sales, organic sales, and so they have they have very detailed information about their sales in their 10K. Every questions that we have right now, even though it's not on top of our head, but we will definitely find the information in their 10K.
Yeah. All right. Looks like that is the end of questions. Unless somebody else has a last minute question. Going once, going twice. All right. Thank you, everyone. So this was, a real life example of how we do our valuations, and then it goes through rigorous discussion within our team about, we ask questions of the valuation, about the assumptions that went into valuation, about the risks, about, social environmental impacts, and lots of other things. And then this valuation will now, based on this feedback and, questions, it will undergo revision, and then revision again, and then a couple of different iterations of that, after which we get together as a team, and then we vote on the final recommendation, and that is the point where we actually make a trade once it's approved by our faculty advisor. So yeah, just give you a little bit of a glimpse into our process. We're now going to announce our winners for the Kahoot. Most people did really well. Oh, screen sharing failed to start. Please bear with me a moment while I wrestle with technology. There. So congratulations, Hilal, Cam, and Larry. Please shoot me a message on chat with your email address so I can send you your gift cards. Great job, everyone. Thank you all for participating. And we will now open for questions overall about our team. You can reach us on our email, at our YouTube channel. You can connect with us on LinkedIn. We also have our own website on the Seattle U website. And then recently, Seattle U did a news story on us. You can find that at this link here. But yeah, that brings us to the end of our discussion today, and we would love to stay in chat with you and answer any other questions you all have. Someone please talk.
When is the next round of hiring or recruiting?
Thank you, Joe. So we do recruit twice every academic year. Joe came in during our last round of recruiting last quarter in the fall. And the next one we'll be doing will be in spring quarter. So next quarter, we'll probably start announcements and open our application sometime. Are there any potential applicants here, perhaps? Ravi, I'm seeing you nodding. Ravi is in one of my classes. Yeah, that's great.